I'm pleased to say that we're joined by Zhang, who's the head of China research at HSBC. Thank you very much for coming onto Bloomberg TV and talking to us.
For having me.
Great. Can I start by asking you, how important is China as an export market for European countries like the UK and Germany?
It's very important. As you know, that the EU is China's largest export destination, not the US. So from that standpoint, that bulk of the Chinese goods are actually heading toward this part of the world.
How much is the UK and Germany shipping to China? Is that a trend that should continue?
No, we hope. Of course, China try to balance its trade figure, especially try to buy more high-tech, high-value-added goods, and therefore, European countries, the two you mentioned, UK and Germany, should be poised to gain from China because China has no intention to build up more foreign reserve.
That brings me to how stable a market is China. We've had a surprise rate hike. Is inflation a real worry in that economy?
Well, inflation, this will be China's inflation fighting year. Inflation is a big concern. Near term, you have the China's local credit overhang on back of the 4.2 trillion fiscal stimulus. And also in 2009, you have 9.6 trillion bank loan growth, which tripled the normal level of the Chinese annual bank loan growth. And last year, you have close to 8 trillion again. So that's the domestic backdrop. Externally, you have Western world keep zero interest rates and engineering QE or even QE2. And plus you have a weakening dollar, rising commodities, and that put pressure. And medium term, I think because China tried to re-engineer its economy toward a domestic consumption-driven one, which means they're going to allow and encourage a faster wage and salary increase. So eventually, from the wage salary increase standpoint, you have pressure as well. So it's a tough task to handle.
Well, one argument is that raising rates alone is not enough and that appreciating the currency might be another solution, one that the US constantly goes on about. Would that help the Chinese stabilize the inflation picture?
I don't think currency appreciation per se is the solution, although marginally it helps a bit. If you look around that since China depegged its currency to dollar in July 2005, if you look at the total trade figure, China continues enjoy steady trade net export growth, and despite RMB appreciated cumulatively 21 to 22%, and in real term even more. And you look around other countries' experience, for example, Japan, its currency strengthened multiple times since the 80s, and then it still runs trade surplus.
I want to turn you to this rebalancing of the Chinese economy. Some argue that the building of infrastructure is actually leading to an asset bubble, though others say it's part of the urbanization drive, trying to bring more rural people into cities. Which do you think is the more persuasive factor?
I think up to now, at least, especially for the early stage, it's more for urbanization because even up to this date, only 47% of the people living in the urban area, and China's aim is to have 70–80% of people living in the urban area. Of course, if you build too much, excessive build-up in infrastructure, there is a certain risk of asset bubble, but I don't think we are approaching that end yet. And plus, people talk about China's property sector bubble. Yes, valuations are high, but they don't recognize that neither the households nor the banking systems is leveraged. For example, from the household standpoint, only 6 to 7% of the households had a mortgage. And if you look at the banking side, only 14 to 15% of the loans are mortgage related. So even the price is correct, you're not going to see the vicious cycle experienced in the Western economy that result in depression.
food prices have also gone up around the world, and
Right.
that is typically something that's thought the Chinese government would worry about. How much of a worry is it in China?
China is concerned about rising prices, especially given the headline CPI has 1/3 of it in food. However, China is largely self-sufficient in major food category, maybe except for soybean, which during President Hu's latest visit to the U.S., China just signed an import contract for soybean worth of $6.8 billion US. So in the other major food category, China is pretty much self-sufficient. And plus, you have, on the central government side, China runs a solid balance sheet that allows the government to provide various type of subsidy to fix the prices if necessary. So I think it's a concern, but in case of China, because of this self-sufficiency, I don't think the risk is that high that food prices will run out of control.
Very finally, you said this is an inflation-fighting year for China.
Yeah.
How do you think the Chinese will be able to manage near 9% growth and combat inflation and stop overheating?
Actually, that is our house view, that we'll have close to 9% of growth. And if inflation is measured by the Chinese headline CPI, we think that the first half of the year will have more pressure, part of that due to the base effect, because Chinese inflation didn't pick up till second half of last year. And you will see policy will be front-loaded. As you can see that already you have one reserve ratio hike, and today you have another 25 basis points interest rate hike. So and plus you have bank level, micro level credit tightening continues, and with all these policy tools in place, we think that our baseline case is that probably headline inflation will peak out by the end of the first half of the year. So it should be under control, although inflation probably will be 5 to 6% high, but the risk of runaway inflation is still low in our view.
Terrific. Thank you very much for speaking to us today.
Thanks, Lena, for having me.